Hi, welcome back. Markets have been feeling pretty unpredictable for a while now. There's lots of talk about interest rates and inflation and global tension around Iran and oil prices, and it creates the feeling of, should I be doing something with my investments? And honestly, that's a completely normal reaction. My name is Melanie Davies. I'm a licensed independent financial advisor. Everything I share here is general information only. It's not personal financial advice. So always get advice specific to your situation. My financial services guide is available to download from the link below. You might have heard people talk about the taco market or the nacho market. Now, it's a bit tongue in cheek, but the idea is that markets react to big dramatic headlines and then recover when things don't end up being as bad or the complete opposite as what was expected. And that's what we've been seeing a lot of right now. So sharp drops followed by quick rebounds. And whether you call it a taco or a nacho or something else, the underlying reality hasn't changed. And that is that markets react to uncertainty and move on new information. And they go through cycles. So what matters most in times like this is understanding how markets actually behave and avoiding mistakes that tend to derail us the most. Let's take a big picture view. Even though right now it feels very uncomfortable and it's not unusual, volatility, which is the swings we're seeing, are a normal part of investing. And historically, after major downturns, markets have recovered and continued to grow over time. So the real issue isn't volatility, it's how people respond to it, because this is where things tend to go wrong for a big part of our population. Let's go through quickly the most common mistakes investors are making right now. The first one is panic selling. Markets move up and down, even though we've seen a rebound, those recent swings can still feel really uncomfortable. So people sell to stop the loss. But what it actually does is it locks in the loss. So they turn a paper one into a real one. And often the recovery happens after they've sold. The next one is trying to time the market. So this is one of the most tempting ones. I'll just get out now, but I'll come back later. But to get this right, you have to make two perfect decisions: when to get out and when to come back in. And in reality, that's really hard to do. Third one is making big reactive changes. So when markets feel uncertain, and rightly so, at the moment it does, it's tempting to do something drastic, to move to cash, switch your portfolio to a defensive asset allocation, or switch to whatever feels safer. But these kinds of decisions are usually driven by short-term fear and not long-term strategy. And often they don't just reduce risk, they mean missing the recovery when it comes. The next one is stopping your investment. So this one is really subtle but important. People invest consistently when markets feel good. And when things drop, they pause. But this means missing out on great buying at lower prices, which is the exact time that can improve your long-term returns. And underneath all of this is emotion. When markets rise, people feel confident. And when markets fall, people feel nervous. And those emotions drive decisions. But investing based upon how things feel this week is very different to investing based upon a long-term plan. So what should you actually do instead? With this, the part people expect to be really complex, but it's actually really simple. Firstly, come back to your plan. A really good question to ask yourself is actually, has anything changed about my goals? Has my time frame changed? If the answer is no to both of these, then short-term market movement alone usually doesn't require big changes. So stay invested for the long term. Long-term investing works because of time in the market, not because of perfectly timed decisions. Trying to jump in and out tends to create more risk, not less. Also, you need to keep investing consistently. This is where volatility can actually help you. When prices fall, your regular contributions buy more. And over time, this can improve your overall outcome, but only if you stay consistent. Also, you need to stay diversified and invest in quality. Not everything moves in the same way at the same time, and a diversified portfolio helps reduce the impact of one asset allocation falling, and it makes the overall journey a lot smoother. Also, accept uncertainty. It never goes away. There's never a moment when everything feels really clear. There's always a reason to be cautious or feel worried. Markets don't wait for certainty. They're forward-looking indicators that move ahead of bad news and recovery, often before it shows up in the data or feels obvious. So a perspective that helps is while the markets can feel uncertain right now, and you're hearing a lot of headlines about taco markets, nacho markets, oil prices, inflation, interest rates, remember, look back over history. Look back at times like COVID or Brexit or presidential elections, which to a lot of people felt really overwhelming and confusing at the time. But markets recovered, and often they recovered before things actually felt better. Okay, to wrap it up, times like this don't just test the markets, they test investors as well. And the ones who do well long term aren't the ones reacting the fastest. They're the ones that stay consistent, avoid big mistakes, and stick to a long term plan. And they consider times like now. And if this is something you want to know more about, watch the video called Why Investing Feels Risky and What Smart Investors Do. That one's up on my channel and I'll link to it for you. And if you do have time, please subscribe. That would be great. Thanks for watching. I'll see you in the next one.